Hope you're back. Hope you're back. Let us do the next problem on cost of capital. This will be one full-fledged problem, which will be covering all the aspects. So you can come to this problem. You require to determine the weighted average cost of capital of the firm using book value weights, market value weights. So we should do using both the ones. The following information is available for your pursual. Present book value of the firm's capital structure is debenture, preference share, equity shares. All these securities are traded in the capital markets. Recent prices are debentures at 110, preference shares at 120, equity shares 22. Anticipated external financing opportunities are as follows. Rupees 100 per debenture redeemable at par, 20 years maturity, 8% coupon rate, 4% flotation cost, sale price 100. Rupees 100 preference share debenture redeemable at par, 15 years maturity, 10% dividend rate, 5% flotation case, sale price 100. Equity shares rupees 2 per flotation cost, sale price 22. In addition, the dividend expected on the equity share at the end of the year is 2 per share. The anticipated growth rate in dividend is 5%, and the firm has the practice of paying all the earnings in the form of dividend. Corporate tax rates 50%. So we have information here. Preference share information, we have debentures, equity shares, and we have to calculate the weighted average cost of capital, which means overall cost of capital. So first we'll compute the individual cost of capital, and then we'll calculate the overall cost of capital. So let's compute the individual cost of capital now. So first let's calculate what we have: cost of debentures, cost of debenture, cost of debt, cost of debentures, KD. Because it is redeemable debt, I'll use the formula accordingly. That is interest into 1 minus T plus redeemable value minus net proceeds divided by N, remaining time to maturity, N for number of years, divided by redeemable value plus net proceeds divided by 2. So interest, debentures having coupon rate. Coupon rate is interest rate. 8%. 8% on 100, that is 8 rupees, into 1 minus T, tax rate. Tax rate given at the end, corporate tax 50%. So 1 minus 0.50 plus redeemable value. Redeemable at par. Par means 100 rupees. Minus net proceeds. Net proceeds, sale price. Sale price means issue price. Issue price 100. And flotation cost, 4% flotation cost. So if I take 4 rupees out, then I'll get 96. On 100, if I take 4 rupees out, I get 96. Divided by useful life, number of years, 20 years maturity, divided by 20. Whole divided by 100 plus 96, that is redeemable value 100, and it proceeds 96, divided by 2. 8 into 1.5 is 4, plus 100 minus 96 divided by 10. 0.2 divided by 98. 4.2 by 98. 0.0428. If you multiply it by 100, you will express in percentage. .04 Was it 20 or 10 years? I'm sorry. Debentures 20 years. Okay. So 0.0428, or if you express in percentage terms, 4.28%. Right? Hope you got it. That is cost of debentures. Uh, Cost of preference shares, KP. Same formula, only thing is 1 minus T will not come. So I will not repeat the formula. Cost of preference shares, preference share dividend, coupon rate 10% and 5% rotation cost they have. Okay. Coupon rate 10%, that is 10. 1 minus T will not come. Plus redeemable at par 100 minus rotation cost 5%. So you will have 95 divided by over 15 years. We'll divide by 100 plus 96 95 divided by 2. So this is 10 plus 100 minus 95 divided by 15, 0.33 divided by 100 plus 95 divided by 2, 97.5. 0.1059 or 10.59%. Okay, hope you got it. Cost of debenture, cost of preference shares. Then we have the cost of equity. We'll use the dividend growth model formula because we have information on dividends. So cost of equity, K D1 by P0 plus growth rate. P0 net proceeds. Huh? So D1 dividend expected. How much dividend expected? Dividend expected at the end of the year 2 per share, directly given 2 per share, divided by P0. Equity share 2 per share flotation cost, sale price 22. So how much we should take? Net proceeds. So 22 rupees market price, you should subtract 2 rupees minus 2. Plus the growth rate, that is growth rate 5%, 0.05. Tax rate has no impact here. So 2 by 20 plus 0.05, I think you get 0.15 or 15%. Please confirm you're done till here, because now I'm going to do the overall calculation that is in the next slide. Okay, so next one. So cost of debt we have done, cost of preference we have done, cost of equity we have done. Now we'll do overall cost of capital. They said using book value weights, using market value weights. I'll use both. So WACC using book value weights, using book value weights. So what the format? Whatever is the type, the cost, the amount will convert into weights, and the product or the weighted cost product. So we have debentures, preference shares, and equity. Cost of debenture we calculate 4.28 percentage. These are all percentage. Preference shares 10.59. Equity 15%. Amounts, book value, using book value, 8 lakh, 2 lakh, 10 lakh. 8 lakh, 2 lakh, 10 lakh, total 20 lakh. Calculate the weights, that is 8 by 20, 8 lakh by 20 lakh, 0.4, 2 lakh by 20 lakh, 0.1. Similarly, 10 lakh by 20 lakh, 0.5. Multiply the cost with the weight column. 4.28 into 0.4, 1.71, 10.59 into 0.1, 1.059, let's say 1.06, 15 into 0.5, 7.5, 1.71 plus 1.06 plus 7.5, 10.27. That is the WACC, overall cost of capital. And what is the main use in practical life? This number, their 20 lakhs money they have got, that is costing on an average 10.27%. For every 100 rupees they borrowed, they received 10.27 is their cost. Either own cost, either interest cost or opportunity cost. So if they're utilizing this 20 lakhs somewhere in various projects, every project they should ensure at least they get 10.27%. If they get below that, that means their cost will exceed their income. They end up in loss. So this is the minimum return they have to use when we go to the capital budgeting chapter, investment decision chapter. So this is using book value weights. Now let's go for using market value weights. Okay, let's do market value weights. WACC using market value weights. Headings are same: type, cost, amounts. Amounts will convert into weight. This amount will be based on market value. Then product. Debenture, preference shares, equity shares. The cost we calculated 4.28, 10.59, 15. Amounts we have to calculate based on market value. So what is the market value we have? See, they have given all these securities are traded in capital markets. Recent prices are debentures at 110. So the debentures will be at 110. So how are we going to calculate? 8 lakh is based on 100 rupees book value. 8 lakh you divide by 100 will give you number of debentures. Then you multiply it by the market price, which is 110. So 8 lakh is the book value. Divide by hundreds. Then you multiply it by 110. I think you get 8 lakh 80,000. Then preference shares. Similarly, preference shares. We have 2 lakh divided by 100. Then multiplied by 120. 2 lakh divided by 100 will give you number of preference share actually. Then multiplied by 120. 2 lakh 40,000 I believe. Equity shares. 10 lakh by 10. 1 lakh multiplied by market price 22. So 10 lakh divided by 10 multiplied by 22. I think 22 lakh. Only one small point, keep it in mind. If you're using market value weights, in some problem, you might have retained earnings. Retained earnings will come in book value weights, but retained earnings will not come in market value weights. Why retained earnings should not come in market value weights? Because when you take market value of equity share, that includes retained earnings. Correct? So in the retained earnings, I mean, if it is book market value weights, retained earnings should not be taken because equity share market value will include already the value of retained earnings. So total 8 lakh 80, 2 lakh 40 plus 22 lakh, 33 lakh 20,000. Weights, let's keep it in two decimals. 8 lakh 80 divided by 33 lakh 20, 0.265, let's say 0.27. 2 lakh 40 divided by 33 lakh 20, 0.07. 22 lakh divided by 33 lakh 20, 0.66. Okay. Product, the cost and the weight, 4.28 into 0.27. 1.156, let's say 1.56, 10.59 into 0.07, 0.74, 15 into 0.66, 9.9, total 12.2 percentage. Okay. So value will be different based on book value, market value because the bases are different. So please check it out and see if you are able to do it. Can you repeat the retained earnings part? If it is retained earning is given, I will not take it in market value weights. Why I should not take in market value weights? Because in the market value weights, the market value of equity share includes retained earnings. So in the market value weights method, retained earnings should not be taken. In book value will take, but in the market value, retained earnings will not be taken because it is included in the market value of equity. Show the question. I thought you had the question. Anyway, no problem. This is the question. Okay, any other doubts? Shall we move forward? Uh, this is the working note for the book value weights and market value weights. Okay, so I'll move forward. This is regarding cost of capital. Next, capital structure theories. Okay, now capital structure theories is trying to tell you what is the impact of taking debt on the value of the firm. You know the basic concept, objective of financial management, wealth maximization. If company takes loan, is it good for the company or bad for the company? I know some people say, sir, debt is riskier, so bad. No, everything risky is not bad. It can risky means it can add return also to you, right? So you can't stay categorically say no, debt is bad. Debt is risk, no doubt, but it also has some advantages. Okay, let me show you how briefly how the shareholders' wealth will increase, how shareholders' profit can increase. Just imagine the company, it has only equity, which is 100 rupees, let's say. It has taken loan also of, let's say, debt, 100 rupees. Now, how much company has now? From the equity, they have 100. From the debt, they have 100. So now when they invest, let's say, they invest together, invest in business, 200 rupees. Okay. And from the business, let's say you generate 10% return. So 10% if you generate, that is 200 into 10%, that means you're able to generate 20 rupees. Basically 10% is the return on capital employed. Equity 100, debt 100, capital employed 200. On the 10%, you're able to generate 200. And you have to pay interest to the debt. Let's say rate of interest is 8%. 8% means you'll be paying 8 rupees to them. Now 20 rupees you earn, 8 rupees you pay to the debt. So how much available for equity now? For equity shareholders, amount available now is balance 12 rupees. So return for equity shareholders 12 rupees. See, had you invested only your money, you would have got only 12 rupees. I mean 12, you would have got only 10%. Now you could invest, you can generate up to 12%. Where did the 2% came from? 10% you generated, but 2% only you paid to the outsider. So 2% into your pocket, right? So this way, debt can also be advantageous. But if this 10% becomes, let's say, 4%, then what will happen? 200 into 4% means you will generate 8 rupees and you will pay 8 rupees. Nothing will be available to you now. This is the disadvantage of taking loan. This is the uh, default. This is the risk of taking debt. It has return, it has risk. It has both the aspects. So as far as the wealth of the organization is concerned, which is a better one? Should I take debt or not take debt? We have different theories. One is we have net income approach, who says that uh, I'll show you quickly. What they're telling you is this. So if I draw a graph, okay, net income approach, they will tell you. If I draw a quick graph, they say cost of debt is the cheapest. KD is the cheapest, and costliest is KE, cost of equity. So cost of debt is cheapest, lowest. Cost of debt is highest, higher. Now, as and when you mix the both, the cost of equity keeps reducing. This is what net income approach says. Basically, net income approach is telling debt is good. Debt is good. How debt is good? Cost of debt is a cheaper source of finance. When you mix cheaper source, what will happen to overall cost of capital? Overall cost of capital brings down. When cost of capital comes down, cost is less, your profit, your value will increase. So this is basically the percentage of debt, you can say. As you increase the proportion of debt, overall cost of capital reduces. That is net income approach. What is net operating income approach? They say no, it does not matter. How? They'll tell the graph like this. Cost of debt is fixed. Yes, you are right. But what will happen to this is overall cost of capital. But what will happen to cost of equity, you know? When you take more loan, it is more riskier. And if you take more loan, more riskier, what the shareholder will expect? Oh, you're taking more loan, more riskier, give me more return. Shareholders risk increase, shareholders expectation increase. So cost of capital starts increasing. Since cost of capital starts increasing, overall cost of capital KO remains fixed. KO remains fixed. So basically, net income approach says as you take more debt, cost of equity does not change, overall cost of capital change. Net operating income approach tells as you take more debt, cost of equity will increase, but overall cost of capital will remain same. So please observe, cost of equity remains same, overall cost of capital reduces, and cost of equity increases here and overall cost of capital remains same. Then Modigliani-Miller approach, who follows a behavioral format, and he gives the formula for with taxes also. I'll do a problem, you'll understand M&M approach. And the traditional approach says that it is a combination of both. Practically, it reduces up to a point after which the cost will increase. The optimum point is called as traditional point, and there is no formula for it that differs from case to case, scenario to scenario basis. That's what the traditional approach says. But anyway, uh, this is a theory. But solving problems, what you need to keep it in mind is this. Okay, I'll tell formulas. I'll tell you. But did you understand the overall concept? Do you have any questions? What does net income approach tells? What does net operating income approach will tell you? I'll tell you the formulas. What need to be kept in mind. If you have any doubt, you can ask. Okay, fine. Let me tell you the formulas quickly now. When you're solving the problems on this net income approach or net operating income approach, both format remains same. follow this format. One format will be income statement. Other will be valuation, or I can say capital structure. Income statement or capital structure. Now, what does income statement will have? Income statement will have EBIT, or also you can say uh, net operating income minus interest. You get net profit before tax. But in this two things, they don't tell you taxation information. So ignore the tax part. So what you get is net profit or net income. Net income. No tax part. Okay. This is NOI, net operating income. Now, capital structure is value of the firm. No, value of the firm means what? Capital employed. Debt plus equity, capital employed. If we subtract the value of debts, what you get is value of equity. EBIT minus net interest, net income, value of the firm minus value of debt, value of equity. Now, what connects between net income and value of equity is cost of equity. What connects between interest and value of debt is rate of interest or cost of debt, KD. And what connects between EBIT and value of the firm, that is KO. So, three income statement values, three cost, three capital structure. Beautifully connected. Now, what should I do? Multiply or divide? Remember this thumb rule easily. If you have a fixed deposit of 1 lakh, you get 10% interest. That means how much is your income? 10 lakh into 10%. 1 lakh is your interest. Okay. Now, if I give you 1 lakh and I tell you 10% rate of interest, what is the value of the fixed deposit? 1 lakh divided by 10% is 10 lakh, correct? Did you get my point? To compute the interest income, the percentage is multiplied. To compute the interest income, the percentage is multiplied. To compute the value of deposit, the percentage is divided. Which means here also apply the same thing. To compute the income statement, the percentage multiplied. To compute the capital structure, the percentage should be divided. To compute the value of the firm, divide by cost of capital. To compute the value of debt, divide by cost of debt. To compute the value of equity, divide by cost of equity. To compute the income statement, these three things percentage should be multiplied. To compute the value of the firm, these things should be divided. So format will be same for net income approach also, net OI approach also. Only difference is in net income approach. In net income approach, cost of equity is fixed. Overall cost of capital changes. Whereas in net operating income approach, overall cost of capital, that is KO, is fixed, but cost of equity changes. You can write down the simple format based on which we'll do problems. If you have any doubts, you can ask. Okay, is this done? Okay, fine. M&M approach I have to tell. While doing problems, I will tell you M&M approach. First, let us take other problem. Okay, you can come to this problem. KLM Limited has an operating profit of 46 lakh and has employed debt total interest charge of 10 lakh. Existing cost of equity and the cost of debt to the firm are 18% and 10% respectively. The firm has a proposal before it requiring funds of 100 lakhs to be raised by issue of additional debt at 10%, which is expected to bring additional profit of 19 lakh, assume no tax. You require to find out existing weighted average cost of capital and new weighted average cost of capital. Okay, they have not told this regarding should we follow net income approach or net operating income approach. Anyway, I'll tell you what is the difference. Let's write the format first, simple format. One is, first is existing cost of capital, existing. Then I'll come to the new situation. So simple format, income statement, capital structure. Income statement we will write net operating income minus interest will give you net income, no tax. This you divide by cost of capital, you get value of the firm. Interest you divide by cost of debt, you get value of equity, sorry, value of debt. Value of the firm, you can subtract the value of debt, or net income, you divide by cost of equity, that will give you value of equity. Write down the format, we'll fill up the numbers. Okay, let's write down the amounts available now. Has operating profit of 46 lakh. Okay, 46 lakh net operating income. Whatever is given, we have written it. Interest charge of 10 lakh. Interest charge of 10 lakh. So 46 lakh net operating income, interest charge 10 lakh, net income I can calculate simply 36 lakh. Done. Then see what is given. Existing cost of equity 18%, cost of debt 10%. Cost of equity 18%, cost of debt 10%. Okay. Now, it has a proposal that will come to it later. Now, how do you calculate the value of equity? Net income 36 lakh divided by 18%. How much you get? Did you get the point? To compute the value, the percentage is divided. 36 lakh divided by 18%, 20 lakh, 200 lakhs. Then similarly, interest 10 lakh divided by 10%, 10 lakh by 10%, 100 lakhs. So what should be the value of firm? Debt plus equity, right? Capital employed. Value of the firm is same as capital employed. So 100 lakhs plus 200 lakhs, 300 lakhs. So what is the cost of capital? KO will be overall cost of capital KO. That is what is the existing WACC. Value of the firm, that is whatever net operating income is. This is like return on capital employed. What is return? EBIT, right? EBIT, return on capital employed, or this one format. To compute this percentage, income by value of the firm. Income is 46 lakh. Value of the firm is 300 lakhs. To express in percentage, you can multiply it by 100. So 46 by 300. 15.33. In fact, you can also follow the format I told you in the previous chapter, cost of capital. I'll show you that format also. Same answer will come. Type, cost, amount, weight, products. You can follow same format. We have equity, we have debt, equity value, we just calculated 200 lakhs. Sorry, amount. Cost, equity cost of equity 18%, cost of debt 10%, amount of equity is 200 lakhs, amount of debt is 100 lakhs, total 300, weights 200 by 300, 2 by 3, or you can say 0.67, 100 by 3, 1 by 3. Multiply 18 into 2 by 3, you get 12, 10 into 1 by 3, 3.33, total 15.33. Same only, so you can write down. Not audible because I'm not speaking anything. I'm just waiting for you to complete. Okay, done. Okay, fine. Let's go further to the second one, next one. With the proposal as there and requires fund of 100 lakhs and it is expecting additional profit of 19 lakh. So what will happen? Again, follow the same thing, income statement, cap structure, same format you can do. Existing, sorry, this is new, same format, income statement, capital structure, income statement, net operating income minus interest will give you tax, sorry, will give you net income, divide by cost of capital, divide by cost of debt, divide by cost of equity, you get value of the firm, you can subtract value of debt, you get value of equity. Okay, now net income will be 46 lakh existing plus new income 19 lakhs. So 46 lakh plus 19 lakh, 65 lakhs I think. And what is going to be the source of that? To be a way of additional debts. So that will also have an interest. So interest cost will be existing how much interest cost 10 lakh plus new interest cost. How much capital you are bringing? 100 lakhs and on the 10%. That is also 10 lakh. Then 20 lakhs you get, right? So 20 lakh interest. So net income 45 lakh. Okay. So cost of equity 18%. You assume to be same. If you assume same, assume constant. If cost of equity assumed as same 18%, what will be the value of equity? 45 lakh divided by 18%, 250 lakhs. 250. Value of debt 20 lakh by 10%, 20 lakh. So value of the firm 45 lakh, 25 lakh or 250. This is 200 lakhs. 20 lakh by 10, 200 lakhs. So 250 plus 200, value of the firm 450, 450 lakhs. So cost of capital Income 65 lakh, capital 450 lakh. To express in percentage, you can multiply it by 100. 65 by 450, 14.44%. And this also you can do the other way format, the tabular format I told you. You can follow for this also. Okay. Here we have assumed one thing, that cost of equity is assumed constant, the value of equity is changing. You can also assume other way around. You can assume value of equity is same as previous one, which is 200 lakhs. Then cost of equity will change. You can also do that. So value of equity, if assumed constants, then what will happen? The cost of equity will change. That's what the difference between those two methods we discussed, but you don't worry much. If you assume cost of equity remaining same, value of equity will change. If you assume value of equity will remain same, cost of equity will change. That's all the connection. You need to keep it in mind. Cost of debt will not change. No, cost of debt is percentage term, means amount of debt is increasing, but cost of debt is not changing, right? Previously also you are having 10%, now also you are taking a 10%. So cost of debt is not changing, 10% only. Rate of interest remaining same. If the 10% became 12%, yes, that would have changed. But in this case, it is not. Anyway, so hope you got the point. We are assuming cost of equity remaining same. Therefore, value of equity changed. You can also assume value of equity remaining same. In that case, cost of equity will change. Will you please repeat? Basically, I'm telling, if you assume one thing constant, other will change. I'm only connecting two things, the cost of equity and value of equity. We assume cost of equity remaining same, so value of equity changed, right? And you can also assume value of equity constant as the existing, that is 200 lakhs. So if you assume value of equity remaining same, cost of equity will change. If you assume one constant, other will change. That's all I'm trying to tell. Okay, is it done? Okay, I hope we can move forwards. Let's go to the next problem. Okay, I'll just do the next problem, then I'll come back to this. We have this M&M approach. This Modigliani-Miller approach. So that the formula I had not told you. Let me solve this problem, then I'll go to the previous problem. So you can come to this problem first. The following data relate to two companies belonging to the same risk class. Particulars: A Limited, B Limited. expected net operating income, 12% debt, equity capitalization rate. Determine the total market value, equity capitalization rate, weighted average cost of capital for each company, assuming no tax as per approach. Determine total market value, equity capitalization rate, and weighted average cost of capital for each company, assuming 40% as per approach. So basically, with taxes, how the value will come. Without taxes, how the value will come. That's what it is all about. Uh, as per M&N approach, this is what he tells. Anyway, so first is without taxes. Let's complete that. Then we go to with tax. So as per M&M approach, as per M&M, what he says is this: value of levered firm is value of unlevered firm. That's all. He says plus debt into T, but we don't have tax here, so let me not write that part. Levered firm means company taking debt. Levered company taking debt. Unlevered company not taking debt. Value of levered firm is equal to value of unlevered firm. Means whether company takes debt or not, their values are same. Let's do this first. Same format, but we'll do it in a columnar format. Capital structure, value, or the, sorry, first we'll have the income statement, then capital structure. Income statement, then capital structure. Income statement, net operating income minus interest, net income. I'll do for two columns. We have company A, company B. Company A, company B. Capital structure also. Value of firm, value of debt, value of equity. This also I'll do in columnar format, A and B. Okay. What they've given, net operating income, let's write down 18 lakh, 18 lakh equal 18 lakh, 18 lakh. Interest, company A has taken debt, 12% debt, 12% on 54 lakh. 12% on 54 lakh. 6 lakh 48,000. Company B has not taken any debts. 0. No tax. Tax will not come now. Tax will come later. So 18 lakh minus 6 lakh 48,000. 11 lakh 52,000. And here 18 lakh. Okay. Then what about the cost they have given? I'll just write for A and B the cost percentage separately. 2 percentage will come. So I will have two columns. Okay. For A Limited, we have 12% debt. B Limited, nothing. Zero. Because they don't have debt. And A Limited has equity capitalization rate. B Limited has equity capitalization 18%. Equity capitalization, B Limited. That is cost of equity, 18%. I don't know for A how much it is. Okay. I think we can compute the B company first. 18 lakh divided by 18% value of equity. 100 lakhs, I think. Value of debt is 0. So value of equity is also 100 lakhs. 18 lakh by 18%. That's how we got 100 lakhs. 18 lakh by 18%. Debt is not there for B. Unlevered firm. No debt. So value of the firm is 100 lakh. So company B is completed. Value of the firm we calculated. Okay. Let's come to company A. Now, what does this M&M approach tells you? Value of levered firm, value of unlevered firm equal. Both are equal. So value of company B 100 lakhs, value of company A is also 100 lakhs because of this point. Overall value of the firm will remain same. What about the value of debt? Yeah, with debt we can calculate. Oh, they have given already 54 lakh. Debt they have given already 54 lakh. So what is the value of equity? 100 lakh minus 54 lakh, 46 lakh. Okay, then what is cost of equity for this company A? Cost of equity. We have the net income, we have the value of equity. Net income divided by value of equity into hundreds. Net income 46 lakh, sorry, net income 18 lakh divided by value of equity 46 lakh into 100. 39.13. 39, huh? Oh, sorry, not 18 lakh. It is 11 lakh 52. Yes, I'm sorry, I made a mistake. We are doing for company A, right? Yes, 11 lakh 52. 11 lakh 52 divided by 46 lakh. 25.04, I think. Similarly, overall cost of capital, net operating income divided by value of the firm, net operating income 18 lakh and divided by 100 lakhs. It's same actually for both, 18%. 18, get 18, 25.04. Okay, so write down, see if you have any doubts in any calculation. Then I will do same format with tax. Please follow it. Let me know if any amount that I have calculated should be repeated. Is it done? Shall I go for with taxes now? Okay. Okay. Let's go for with tax now. With taxes. As per M&M, he's the only one who explained the tax impact. As per M&M, value of levered form is value of unlevered form, just like the without tax, plus something, plus debt into tax rate. Because when you have debt, you will have interest. Interest is allowed as tax, interest is allowed for tax purpose as expense. You save tax. So this one, basically you save tax, tax shield, saving in taxes due to interest, savings in taxes. That's what the value of the firm will increase as per his thing. Otherwise, format is same. Let's follow. Capital structure. Sorry, first income statement. Then capital structure. I'll have two columns, column A and column B, and percentage also. I'll have two columns. Then value of the firm also two columns. So I'll start with net operating income. In this case, we have interest and tax also. So I'll say EBT minus tax. That is profit after tax, which I call it as net income. Capital structure, value of equity minus value of debt will give, sorry, value of firm minus value of debt will give you value of equity. Okay, let's fill up the numbers now. Net operating income remains same, that will not change, 18 lakhs. Interest, like we calculated, 6,48,000. In fact, I could have continued from there, but anyway, let's keep it separate. 0. 11 lakh 52, 18 lakh. 11 lakh 52, 18 lakh. Okay, now tax is there. Tax rates 40%. tax 40%. 11,52, 40%. 4,60,800. 18 lakh 40%. 7,20,000. So net income 11,52 minus 4,60,800. 6,91,200. 18 lakh minus 7,20,000. 10,80,000. Okay, then what is given? Interest rate 12%. Okay, first you complete this, then I'll do the remaining parts. Okay, let's look at the percentages now, what they have given. Equity capitalization for B Limited 18%. Equity capitalization for B Limited 18%. Okay, and for B Limited there is no interest anyway. Okay, let's complete B Limited part, then I'll come to A Limited. They don't have any interest. So value of equity we can calculate 10,80,000 by 18%, right? B Limited. Value of B Limited you should calculate. Unlevered form you calculate first. So 10,80,000 by 18%. 60 lakh, is it? Okay, 60 lakh. There is no value of debt because B is unlevered. So value of firm is also 60 lakh. Let me just quickly compute the percentage. For B Limited is NOI 60 lakh and 18 lakh. So what is the overall cost of capital? Net operating income divided by the value of the firm. Value of firm. Net operating income 18 lakh. I'm doing for A, okay? 18 lakh divided by 60 lakh into 100. That is 30%, right? 30%. Okay. Now, can you tell me why these two numbers are different? Why cost of capital and cost of equity? Why are they different? Why are they not equal? It should be same, right? For company B, they don't have loan, they don't have debt, no cost of debt. So their cost of equity and overall cost of capital should be same, right? Yes, because of tax. It should be with tax. That is why 30% is not the right number. Or you know what you should do? Or you know what to be done? If you want to convert, before tax into after tax. One simple method I told you. In cost of capital chapter, I told you how to convert from before tax into after tax. I will multiply it by 1 minus T. So in this case, formula should be not just net operating income. You should do into 1 minus T. Into 1 minus T. So 18 lakh into 1 minus 0.4. Now you see what you get. Do you get 18% correctly? 18 lakh into 1 minus 0.4, 18 lakh into 0.6 by 60 lakh. I think now you get 18%. Yes, that should be the number. It should be 18%. When we write the cost, it should be after tax when we write it. Now you see both are matching. Okay. Let's come to the value of A, value of levered firm. That is value of unlevered firm plus debt into T. So value of unlevered firm is 60 lakh plus debt, that is amount of loan 54 lakh. Debt is 54 lakh. Into T, tax rate 40%. So 54 lakh into 40% plus 60 lakh, 81 lakh 60,000. So value of the firm 81 lakh 60,000. The 81 lakh 60 minus 54 lakh, value of equity you get 27 lakh 60,000. Then how do you calculate the cost of equity now? Net income 6 lakh 91,200 divided by 27 lakh 60,000 into 100. $25.04. See, cost of equity remaining same actually. Anyway, 25.04 is cost of equity. Overall cost of capital KO, same formula. What should I do? EBIT into 1 minus T. EBIT is 18 lakh into 1 minus T, 0.4 divided by overall value of the firm. This is 81 lakh 60,000. Into 100 to express in percentage. 13.235, 13.23. So overall cost of capital KO 13.23. Okay, cost of debt I have not asked, but if you have to write, can you tell me what will be the cost of debt for company A? Should I write 12% for company A? Cost of debt, should I write 12%? No, it is before tax. After tax means what should I do? Multiplied by 1 minus T. If you have to write cost of debt, 12 into 1 minus tax rate 7 point Thanks for simple format. Yeah, most welcome. I also did enough research. Different people were presenting differently. Then I thought this format suits the students' mindset from exam point of view. I hope the format is useful. Please write down. Go to the solution once more. Let me know any format that I have to explain. Okay. For cost of capital, KO, institute actually prepares in a tabular format. I'll show you that also. How 7.2% came. I showed you the calculation. Rate of interest into 1 minus tax rate. Rate of interest 12% after tax. So 1 minus 0.4 multiply. I'll just show the verification also for this 13.23 for company B. Institute actually gives that as a solution. So you can also follow it. Anyway, so let me show you that format also quickly. Hope you have done till here. Okay. So quickly I'll just prepare WSCC or KO for form A. Type, cost, amount, weight, product, equity, debt. Cost of equity we calculated to be 25.04. Cost of debt we just calculated 7.2 after tax mandate. Amount of equity, value of equity 27,60,000. Amount of debt 54 lakh. Total 81 lakh 60,000. Calculate the weight 27 lakh 60 by 8160. 0.3382. Let's say 0.33. 54 by 8160. 0.66. Actually, I think we have to round it off. Maybe I'll make it as 0.34. So total is 1. 25.04 into 0.34, 8.51, 7.2 into 0.66, 4.75. So you get 13.26. Yeah, the 13.26. That rounding off because you have taken less decimals. If you take more decimal, it will be more closer. 13.26. We got 13.23. Very close. That's because of round up reasons. So institute sometimes gives this as a solution. You can also present this one. Okay, hope you have done till here. Hope this format is useful. I also searched enough places, you don't find this format anywhere. So please make use of it. Regarding M&M model to be specific. Okay, anyway, so hope you have done till here. Let's take a break now. 11:20 now. Let's take a break of 20 minutes. Then we'll do the remaining problems. I'm taking a longer sessions. Hope the break is also sufficient for you. 11:20 now. Let's meet at 11:40. Fine. Let's meet at 11:40.